This QuickLearn Bullet introduces basic interest rate swaps and their construction and pricing. The discussion begins with a simple 3-year IRS used by a company to hedge its interest rate exposure under floating rate debt. We remind you that familiarity with forward rate agreements, or FRAs, is fundamental to tackling the materials in this bullet. So you should first review our bullet on FRAs if you have not done so already. Assume first that a company has borrowed $100 million for 3 years at LIBOR flat and is required to pay quarterly interest based on 3-month LIBOR. The loan is advanced on January 1, 2009 and thus matures on January 1, 2012, with interest payments being due on April 1, July 1, and so on. If 3-month LIBOR spot is 3%, the company will pay interest equal to $0.75 million on April 1, 2009, calculated simply as 100 million times 3% times 90 over 360. Recall that the numerator in the preceding fraction is based on the actual number of days in the interest period, which happens to be exactly 90, given the inclusion of February. What the company will pay in interest for each of the following periods depends, of course, on where 3-month LIBOR resets on the relevant date, and this could rise or fall from the current level. We would say that the company has exposure to LIBOR in the sense that its interest expense over the next 11 interest periods would increase if 3-month LIBOR rises, adversely impacting the company's financial performance. As a first step, the dealer could quote the company the FRA rate for each of the 11 periods prior to the loan's maturity. The rates shown, which include the dealer's profit margin, appear in this table. The table confirms that the spot rate for 3-month LIBOR is 3%. The 3x6 FRA appears underneath and is quoted at 4%. The 6x9 FRA is quoted at 4.5%, and so on for all subsequent 3-month periods, out to the 12th period that represents the last quarter of the 3-year loan's life, and whose FRA is quoted at 6.75%. The borrower could lock in via individual FRAs the appropriate forward rate for each of the 11 periods for which LIBOR will be resetting. And by doing so, the borrower would have eliminated all future variability in the cost of this debt. This would achieve the company's objective of locking in predetermined payments of interest for the life of the loan, but would leave the borrower with increasing interest payments in each quarter. This presents a problem. It will appear in the company's financials that its costs are rising over time, which would be poorly received by analysts if they do not understand the reason behind this, namely the shape of the yield curve. What the borrower really needs is a smoother pattern of cash outflows, and this is where the IRS comes in. The IRS fixed leg is calculated as the single rate that makes all the cash flows paid by the borrower have an aggregate present value equal to the aggregate present value of the unequal cash flows that the borrower would have paid under the above listed series of FRA rates. This slide shows those rates and shows you the net cash flows the borrower would lock in for each period. One minor technicality to note is that the FRAs here are assumed to settle at the end of their related period rather than at the beginning, since this saves us the need to discount the net settlement only to gross it up again for interest in a second step. Also, we treat each period as representing exactly 1/4 of 1 year for the sake of simplicity. The bank can therefore propose to the client to smooth out the 12 payments so that the company always pays the same exact amount of interest in each period. This table achieves this by deriving first the discount factors appropriate for each cash flow, and then solving for the single constant fixed interest rate, which when applied to the notional generates constant payments whose aggregate PV equals the aggregate PV of the original unequal payments. We initially set this fixed rate at 5%, expecting that it will not be absolutely right, and then we'll use Excel's goal-seek function to derive the rate more precisely. This table confirms that the 5% rate was too low, since the aggregate PV of the new cash flows is meaningfully lower than the aggregate PV of the original cash flows. The difference of 621,000 would in effect represent the upfront loss the bank would be incurring if it allowed the borrower to pay 5% only as the fixed rate. Goal-seek reveals the exact solution, the one that brings the PV difference down to 0, to be 5.2233%. It is customary to show the loan once it is swapped under the IRS contract via a diagram which looks like this. In effect, the cash flows of LIBOR under the loan offset the cash flows of LIBOR under the swap on each and every settlement date, leaving the company paying the fixed rate of 5.22% on a quarterly basis. The swap has enabled the company to synthetically create fixed rate debt in lieu of the floating rate debt it originally had. We emphasize two important features of the preceding diagram. First, all settlements under an IRS are made at the end of the period to which they relate. This is in contrast to FRAs, where the normal custom is to settle the contract at the beginning of the period in question to reduce credit exposures and operational risk. Second, there will be 12 separate settlements under the swap versus, of course, only one under a FRA contract. But the diagram for the swap uses only one arrow in each direction to represent all 12 settlements over the life of the swap. Our approach to pricing the swap so far has contained an approximation, since it ignored the exact day count in each period and treated them all as representing 1/4 of a year exactly. This slide here now uses the exact day counts and bases itself on an actual 360 convention for both legs of the swap. The individual cash flows are significantly different from the ones in the previous slides, but in aggregate, the differences cancel out to a large degree, on a PV basis, of course. Using goal-seek once again enables us to calculate the swap rate correctly, which for now has been incorrectly set at the 5% rate once again. The exact solution this time is revealed to be 5.2263%, extremely close to the previous solution. We use algebra to derive a closed-end formula for calculating an approximate swap rate merely from discount factors and FRAs. Under the simplified approach we used earlier, we were effectively making use of the following equation that you see here. In turn, this formula simplifies into what appears now, where you will notice the n for notional dropping out completely from the formula. This last formula, which we show again, is often paraphrased by the statement that a swap is the quote-unquote time-weighted average of relevant LIBORs, spot and forward, of course. This concludes this QuickLearn Bullet on interest rate swaps and their construction and pricing.